Welcome everybody out there to our next webinar here at JFD Brokers, and in the name of JFD Brokers as well, a warm welcome. My name, Stefan Friedrichowski, as always, for those kind of webinars, those kind of topics, and those kind of approaches to trading. Today it's once again about stock trading, and it's indeed already part 3, and it will be the final one that I can promise. And I can promise already a little bit about the final result today. It will be a very simple strategy. And we have been already quite close in part 1 and part 2, but finally I will show how we reach our final destination, final strategy for stock trading. At least one kind of stock trading, how you might do it by your own as well. And it will be that simple. So it's something for everybody's trading portfolio. That is, by the way, always one thing I want to emphasize here, that I like stock trading, especially because of two reasons. One is stocks have an intrinsic bias, and that bias goes north, meaning if you open trades, we have that statistical edge already on our side, and that's quite good. Of course, we know that there might be financial crisis or whatever might happen related to trade wars or whatever. And in those times, even stocks may go south. But if we do it right, then we step out at the right time, or at least not too late. And finally, we can participate in increasing stock prices, and that's quite good and well. You see already my email address, so if you have questions later, or if you want the slides or the Excel sheets I show here around, then just send me a note. Okay, the slides you can have already, because those you can download directly here via the GoToWebinar control panel. And of course, I have to mention, because this is part 3, and I will briefly touch what we have done in part 1 and part 2 as well. But there are recordings available for those webinars, and how to find those. What I would do is I simply would press YouTube JFD, and then you go to the YouTube channel of JFD, and here we are. In a second, did I open it? Yes. It will take a minute, or hopefully not a minute, only a few seconds, but then you are directly at the YouTube channel. That the internet seems to be slow here has a specific reason. The reason is the webinar itself, because my upload is limited, and even downloads are then affected by that bottleneck of uploads. So here we are, and you find those Power Webinars, JFD Power Webinars, and you see already the German version of today's topic. And if you see show more, then you will find the other ones, stock trading part 2 and part 1 as well. It's on the next page here. So it's easy to find. And by the way, a lot of other interesting webinars here as well. Good. That's the one thing. The other, as you know, I always have to show the next slide, and the next slide is there was disclaimer, because we talk here about trading strategies, and you may adapt those strategies for your own trading activities. But of course, finally, you do everything on your own and your own responsibility, and that has to be said at least once per webinar. Okay, that's well done. And talking about risk or trading strategies, just to mention, few of you might have already realized that we have something new here at JFD, and I will show that as well, because there's a new trading strategy on the JFD Invest platform, the social trading platform, so that you can mirror those strategies into your personal JFD Invest account. And you see we have a new number one. It's a really well-doing strategy, FX Global, and that has a year-to-date performance since April of more than 40%, which is really amazing. And if you look for the equity, yeah, you see straight line, more or less, quite well. And it's even doing well in terms of equity balance deviation. So difference between floating losses and the balance. Okay, there's a minus 9% here once during the last 7 months, but you see in overall, all the 7 months are green, which is really well. So it's a really nice strategy. And I have to say, because I'm always frank with that kind of information, that strategy is not coming from my end, it's somebody else. So beside Eurodream, all the rest here are my personal strategies. You can participate here as well, but just check out. You can start that web page also directly from the JFD homepage. You go for investing, but let's go to today's topic. So we talk about stock trading, which is, by the way, not part of JFD Invest up to now, because those strategies are running on MT4 only. And since what we are dealing here today is real stock trading. That means what we try to do is buying real stocks. That means long only, of course. Otherwise, we would not have that fundamental bias for stocks. And yeah, in principle, you could trade CFDs on stocks as well. But then you have swap costs because yeah, you borrow money and you have to pay interest rates for that, and therefore, yeah, real stock trading has an advantage, but you need maybe a little bit more investing capital for that. Later, when we go here, I have in mind a total amount of 100,000, but I can tell you, you can downscale that at least by a factor of 10. Then finally, you might not be able to buy all the shares which build the S&P 100, because that will be our final portfolio, all those strategies within the S&P 100. Why would you miss a few one? For example, I always go for the example of Apple. Apple has a price of about 200, and normally for my 100,000 account, I would use 1,000 euro per strategy or per stock. And therefore it works, and I could buy 5 stocks of Apple. But if I go down by a factor of 10, then at least I could not buy Apple anymore, because for 100 euro I cannot buy a single share. Okay, but most of the stocks are below 100, and therefore we can scale down the strategy by a factor of 10 about. What we do here is first we do a recap of what we have done. And basically what we have done is we have used 3 kind of principal strategies: EMA cross, trailing stops, and high trading. Of course, you might comment on trailing stop. Trailing stop doesn't sound like a strategy or because it's more a methodology for applying a stop loss. But in this case, we even use just the trailing stop as a strategy itself. And it worked. It has not been the best one, but even that worked out here. And then what we did in part 2, we did a combination of those 3 individual strategies, leading to those 4 kind of combination, 2 combinations, and 1 is 3 of all. And we looked in detail to what we achieved for the overall portfolio, trading all the 100 shares of S&P 100. And then we realized we might need new options. And those new options are heist trading with a different exit multiplier. Okay, you will later see what I mean with exit multiplier. And we thought about using the volatility as maybe an exit signal. If volatility increases, normally that might be a hint of that we go in the crash mode and everything goes south. So volatility might be an indicator for those phases, and later we will use simply the ATR, the average true range, as a measure for volatility. At least that's one possibility. And finally, we go for the winner. So the final strategy, which will be indeed extremely simple. So let me go quickly through our base strategies. EMA cross. EMA cross is really simple. Well, all we do is we look to the close of a day compared to the EMA with a certain period. And if we are above, we go long or we keep our trade running. And if that close is below that EMA, well, that's a signal to close the trade, or if we have to decide for a new trade, to not trade. So if we are below specific EMA, we step out and will not open any new trades. So that's EMA cross. Extremely simple. We always do our decisions on the close, which would mean at 10 p.m. German time for those United States market, and that price would trigger out the decision. But what we do, finally, we do always at the open of the next day, so we have enough time to prepare ourselves. So it would be really easy to do. Finally, that's for all strategies. The next strategy was just the methodology, trailing stop, which means we open a trade, and that trade gets a stop loss. And that stop loss is X% below our entry. And then later, for the next coming days, we always look for the last low of the previous day, and we decide, hey, that low minus our X%, if that is above the actual stop loss, then we shift our stop loss upwards. And yeah, that's one way for applying a trailing stop. So it's quite easy. And we will see the summary of all the results. Finally, there was a third strategy that was heist trading. And on that page, I will keep a minute because we later go for heist trading once again, and that will be interesting. What we can do out of that strategy, heist trading. I have no better idea how to name that. So basically what we do is we look how long ago, how many days ago is last high within the last trading year. And if that high is not older than, that's our parameter, X days, then we open a trade. And we keep that trade open until the last high is older than 2 times that number. Let me quickly, because that's important, go into a chart and then illustrate that kind of strategy. So let's, as always, we go here for our Apple, just as an example, and I want to illustrate how that heist trading is really running. So let me even zoom in more. And now we have here the daily chart for Apple. Let's assume our X days equals 20 days. So, and we have to decide today or a couple of hours ago whether we can open a trade here for Apple. Then what we would do is, okay, we look for the previous day and we count how old has been or is the last high. So it's 1 day, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So the last high is 11 days old. Okay, so if our threshold is, let's say, 20 days, okay, then it would mean we open a trade. So we would have opened the trade at 3:30, and then that trade would be running. So now, when to close the trade? Okay, we have to wait a couple of days, certainly. If from now onwards the price of Apple would not create any new high, then since our high is 11 days old and our threshold, our trigger would be 40 days, always 2 times the entry threshold. So if we would not have any new highs here, so our trade would still go on for 29 days, and then we would close the trade. If in the meantime we would get a new high here, then we would always reset that counter, meaning from that day onwards, we would have to wait 40 days until we close if there will be no new high. So it's a really extremely simple strategy. The question will be, is that factor of 2 between entry and exit, which has been set just by chance, looking out of the window and the window's telling me, oh, go for twice. No, that will be the question later. So if our threshold would be, for example, 10 days, then we would not open a trade today. The idea behind that strategy, and there are similar strategies, one is called Darvas strategy, is always only stocks which create new highs are going north. So we use that information of creating new highs as a selection criteria for a good share. And if you look here into the past of, for example, Apple, then you see, okay, we have a new high here, a new high here. That would be the next new high, the next new high, and the next one. You see, let's say about every 10 to 20 days, we have a new high, at least within that period of time here. So it would mean here it's time that it goes up once again. So we have always those new highs in not too many days, and that means overall the price goes north, which is perfect because that's exactly what we aim for. So that days since high is a good filter for good shares, and therefore I like that kind of strategy. And yeah, that was a strategy, Heiß Trading, which we use later once again. Now, that's a summary already. The summary of all 3 individual strategies, always with a certain parameter number. And what you see here is not a single share. No, it's always the portfolio of trading the 100 shares of S&P 100. And then finally, you would get that red line for the last 18 years being the equity, and the balance would be the blue curve here. And all 3 look nice. And what we realized because we have looked to a couple of other numbers, that in principle, one can state, okay, the higher those numbers, the better, or at least the more profit we get. But in most cases, on the costs of high drawdowns. And even here you can see, if you go for the trailing one with an initial stop loss of 16%, you see, oh, we have good profits, more than 200,000. Okay, but we have a drawdown of about 70,000. Wow. So that drawdown is always our biggest problem within those strategies. They are doing well most of the time, but the financial crisis 2008 to 2010 hit them really hard. And that was the point to say, maybe we can do a little bit better. But overall, if you look for except those 2-3 years here in the middle, it's already very good and attractive strategies. So what we tried next step has been to combine strategies, EMA trailing, EMA highs, and so on. And the final result we got, just 4 examples here, are the following equities for the overall portfolio. Once again, we saw and we realized an improvement. So if you look, for example, to the drawdown here is 20,000. Here is 20,000. So in all 3 cases, it's about only $20,000. But still, we might do a little bit better. What we additionally have done was a comparison to the benchmark. Unfortunately, I don't have a chart for the S&P 100. Therefore, I took the S&P 500. And that comparison is really impressive. You see the drawdown within the S&P 500 financial crisis. It's really from 1,500 to about 750. And overall, for the last 18 years, the S&P 500 has doubled. Our equity looks already much better than the benchmark. Drawdown is less, overall increase is higher. So that's already really good. The problem is the drawdown, especially in financial crisis. And that led to the idea using 2 other things here, or at that time it must have been 3, but the middle one, the B, I have to skip because it doesn't work out. I tried it and I have skipped it afterwards. So we want to use the days since high, but not with that intrinsic multiplier of 2. So entry, for example, 20 days, exit within 40 days or after 40 days if there's no new high. So that factor of 2 we might vary. And the other has been that volatility. So using the volatility as a trigger to step out. Let's try with that first. Of course, in principle, I'm talking about volatility. And there are methodologies for measuring volatility. And for example, there are even indices for that. For S&P 500, there's an index which is called VIX. And that is a number which tells you about the volatility of the market. The higher, the more volatile, the lower, the more stable. And what we normally observe is if that index, that volatility index goes high, it's, or in most cases, related to a crash situation. And if you have low volatility, then it means, okay, everything is all right. In principle, it might go north with indices. But if it would be that simple, then trading would be really easy. So it's a good indicator, but it's not telling you everything. So since we now want to have an indicator on individual stocks, we need something else. And what I thought, okay, why not just go for ATR, so the average true range, which is something also related to volatility. And the basic idea has been to say, let me start that sentence once again. So now I want to step out if volatility is high. Now my problem. What is high and what is low? It's easy to say terms like that, but we have to measure it because we want to have a strategy based on fixed rules. And therefore I said, okay, why not going for 2 ATRs? Because the ATR has a period. So we can have a slow one and a fast one. Slow is always related to higher periods, let's say ATR 200, and another ATR which is maybe only 20 or 50 that period. That can create higher numbers, and then we can compare that fast ATR to the slow ATR. Let me show you in a chart what I mean. So we have here the Apple price, and now we want to have an ATR within that. So let me throw it here, and I want to have one, let's say, with a period of 200, and okay, and then a second one, which is with a smaller period. Let's go for, I don't know, 30. Unfortunately, it would be much better to have both in the same chart because then we can see when they will cross. Therefore, at least I can use a minor trick because I do it with fixed scales here because then it's easier to compare the two pictures if I have fixed scale for the 2 ATRs. And then we see, for example, right now, as we speak, the fast ATR is higher than the slow. And the idea is that is a trigger for stepping out. And we would open trades, for example, in situations like here. You hopefully can realize without just clicking on those numbers that this number is lower than this one. And that means, hey, let's jump into the market. So we might open a trade, which has been a good trade. You see, and later about here, we would have stepped out because volatility increases above the slow ATR. Slow means high numbers for ATR periods, and then we step out. And it doesn't work badly already here within that chart visually. So 2 ATRs, and it's really amazing that this already creates this trading strategy. Let me show you. We open a trade if ATR slow is bigger than ATR fast, and we close that trade exactly when those two lines cross. That's all. And this is already a strategy. Believe me. Here are the results. Results already directly for a complete portfolio. And the nomenclature here is quite simple. If that picture is labeled with ATR 256 slash 64, it means the fast one is the 64 and the slow one is the 256. So those two ATR periods, and what has been traded, once again, the complete portfolio, and you see equity and balance in red and in blue. What do we realize? First, it worked. It worked out. So we have, once again, a quite easy and simple strategy. It's volatility trading. And even only with volatility trading, we can achieve already results of about 100,000 profit. But now the but. Especially the target or the original idea for that kind of strategy does not work that well. And I tried a couple of combinations, and no, it doesn't work. Still, we have the high drawdowns, and exactly those have been the one we want to get rid of here, but it doesn't work that well. On the other hand, the good thing is you can do more or less whatever kind of combination of the two periods. It always worked. That this is indeed the case, I want to show with that funny graph. And you might remember we have had a similar graph within the last two webinars. So that's not an equity here. It's something strange. Let me quickly explain, because we have a second one later, how to read that chart or how that graph is created. Within that Excel sheet, a single line, the first line here, is representing one share, which has been traded those 18 years. And now we have here the two numbers, the two important numbers, the ATR slow and the ATR fast. And that share has had a profit, so it's a minus number, of minus close to $700 over the 18 years. And the list here is sorted along the profits. So that was the worst strategy for that combination of ATR slow and ATR fast. Then we have the second worst, which is this one here. And what I do is I sum up those numbers. And those create that curved line. You see, here's the number 100. So it's the 100 different shares within the S&P 100. And you see that about one quarter, so 25 strategies are negative. Therefore, the line goes south, and from then onwards it goes up, which means finally the complete portfolio is positive, but not that good. And then we start once again here at 0 for another combination of the two numbers of ATR slow and ATR fast. So what do we have here is a quick overview about different kind of combinations of ATR slow and fast. And you might just look for the tops here. Then it's telling you, hey, it's overall quite stable. So I can more or less do whatever I want for slow and fast. I create a profitable overall strategy. And you see, because the higher numbers are the one to the right, higher numbers are good here as well. But overall, it does not really depend strongly on those two periods. If you just look for that cross, it worked already as a trading strategy. And for three kind of combinations, I illustrated the overall portfolio performance within those three graphs. So volatility was a good idea. It worked, yes, but what we tried to achieve to get rid of the drawdown was not that well. Let's go for the other idea, the second one, heist trading. So it's the slide here is quite funny because it's just a copy of the one we discussed already. And you see the only thing which is new is exactly what I put in here in green. So the idea has been, okay, why exactly go for that factor of 2 between entry, trigger, days of high, days since high, and exit? We might go for other multipliers as well. Why not? So we can try it. And the good thing as well is that we created already an Excel sheet for that kind of approach. And here we have that Excel sheet where you can simulate a single stock just within Excel. It's once again Apple. And you see that the only thing, if you want to go for other shares, then you have to replace the prices here with other data. And that is the Excel sheet for Heist Trading. And originally, we have had only one parameter, and that is highlighted here in yellow. And that is the entry days since high. And then if I click on that cell here, then you see then we simply double that number for the exit. And all I have to do in order to get that strategy now for other numbers, I have to replace that number directly by another number, for example, by 32. So now I have 2 degrees of freedom, and I can try to get better combinations, for example, with those kind of numbers, this kind of numbers, and so on. Now strategy is getting a little bit better. In principle, what we can do with that kind of Excel sheet is we can optimize, but only for one stock at one time, so for one company. And you can do it by your own. And if you like, and if you have interest in that Excel sheet, no problem. Just send me an email, as always. And then you can figure out how to trade that company, and so on and so forth. That's the main idea of that webinar series here, with this third part now, is that I always want to try everything, one set of parameters for all. Of course, I can optimize everything for a single company, but exactly that I do not want to do here, because we are going daily. We don't have that many trades, so statistics is poor. Therefore, I want to have that kind of statistic out of the portfolio, and therefore I use the same set of parameters for everything simultaneously. And that's the reason why I don't want to optimize for a single instrument or a single stock company. So now we can have that multiplier, and we can look how that worked. And once again, we have now it's a little even more. You know how to interpret that funny graph here. So it's let me see what is running first. So first, the first curve here is the day since high was number 4, and the multiplier is 1, meaning it's a 4-4 strategy. So day since high 4 for exit, day since high 4 for exit. And then we have that curved line. And then we go for the next one, which is then 4-8, and then so on and so forth. Overall, you see higher numbers are good because those higher numbers are at the end here. Overall, it's not depending that much on, once again, on those parameters. You have to remind yourself. In most cases, I always double a parameter. A double parameter in the trading strategy is really something we normally would not do. Think about you think we have a trading strategy with an EMA of 100, which worked well. Then it's nice if it still worked with 120, but normally you would not change those numbers by a factor of 2. In this case, everything worked, still even doing that doubling with those numbers. But let's have a closer look to equities of a complete portfolio. And let me go back to my slides. Then here we are. Labeling is easy to read. So now we have 2 numbers after days since high. The first one is for entry. The second one is for exit. And you see on a first view already that it worked well in principle. So we have, once again, strategies earning more than $100,000 here. But we have a but still. Let's start with the right one here. So days since high 64, 256. Very good profits, 250,000, but highest drawdown. But the good thing now is, let's go to the left. If we go down the road, smaller numbers for the exit, it's getting better. And it's even getting better once again if we have the same numbers for exit and entry. Let me look for that equity on the left. So still we have a profit of close to 120,000 and a drawdown of about 15,000. Okay, that's a factor of 7 to 8. Let's compare it to with the right one here. So in total we have 250,000 profits, but we have a drawdown of about 50, 60, maybe it's about 70,000. So that's something I'll always do. I just compare drawdown with profit and then just divide those two numbers. So that means here on the right hand, we have a little bit more, between 3 and 4 times profits compared to drawdown. And on the left side, we have about 7 to 8 times profit compared to drawdown. That's always good. Since I started the webinar with looking to JFD Invest strategies, that kind of combination I do always when I go for those other strategies. I compare the profit with the drawdown, and that ratio is telling you lots about that trading strategy. So that's always a quite fix, quick and dirty key figure to judge about trading strategy. So here the left is the best, 15,000. And maybe let's relax here. Looking for that strategy means it's extremely easy to do. We have just look for days since high, in this case 64, and the good thing is that strategy is extremely robust, meaning you can change that number, but still you have very good results. So it's intrinsic stable, so to say, and it's not that bad. Having a factor of 7 to 8 between profit and drawdown, that means we can earn a lot of money with that strategy. Still, I have to remind you that we are not reinvesting money. So it's not like you would do with normal trading. If you have profits, you might reinvest those profits. No, here we constantly buy, whenever we buy, for $1,000 stocks, shares of a single company. We do not increase that value. In principle, you would increase it over time if you have already gained some profits. Then that curve would go exponential. So you can even earn much more money than shown here, doing that kind of reinvesting profits. On the other hand, I always go here because I hate that exponential behavior. It only looks good, but it's better to have here a linear behavior than everything is all right. So we can profit factor of 7 to 8. Let me summarize that, because that is really good. And that's why I'm put the title here, and the winner is. That's fair enough, that this simple strategy is already extremely good. Super simple. Drawdown 15K, profit 115. That's the factor of 7 to 8. And there's another figure I always look. That's what I call the time to recover. The time to recover at the worst situation within the last 18 years is here about 2 years. And I mean with time to recover from that high to this high, or when we are back on the same level. So that is about 2 years. Okay, I know within those 2 years you would not feel good. But overall, look to all the other years, there's most yearly profits are positive here. And let me switch back to the S&P 500. Let's look for time to recover. So we have a very long period, 1, 2, 3 times. That's about 7 years. And from here to here, it's about 5 years. So the time to recover within the S&P 500 is much higher than within our strategy. And here you still see the old one and now the new one with days since high 64. Now we have only 2 years. A profit multiplier of 7, profit compared to drawdown, and time to recover only 2 years. Still, I know those 2 years would be hard. Yes. But how often we have realized that kind of behavior within the last 18 years. So worst situation here and second one here, but that's already just 1.5 years. So that's better. That's okay. And also the remaining time, we have a constant increase within that strategy. Just looking to the balance of that strategy is even better. Of course, to look for balance is always better than to look for the real equity. Then the drawdown is even below 10. It's about 7 to 8 thousand euros. So that's quite well. Summary here is that 64 days since last high. So even if you think about, can I trade that portfolio manually? The answer is yes, of course. Because, okay, if you want to start today, yeah, then you have to click through 100 charts. I know, that's a tough job. But if you have opened those trades, if you can open according to those rules, then you can remind yourself because you simply count the number of days. And if you today open the trade and you remember Apple, 11 days old is the last high. That means for the next 53 days, you even don't have to look to the chart. After those 53 days, you look once for the chart of Apple, and if there's a new high, you can reset your counter and get the new number, how many days you can wait until to revisit the chart of Apple. So it's quite easy. Finally, you would realize that you may have to look to 2 charts per day. Okay, that can be managed. And you have time always between 10 p.m. and 3:30 p.m. the next day. So there's enough time to look for those 1, 2, 3 charts. That's all. It's only at the beginning you have to do it a little bit more. So it's super simple, that kind of strategy. And therefore I said, that's the winner. And that's fair enough. And we know the strategy is extremely stable because we can turn around those numbers. It doesn't have a big impact on the strategy itself. So it's really cool. Super simple. Can be traded manually without any expert advisor. And even with a portfolio of 100 stocks, as I mentioned. So then I'm already at my summary. So our approach with heist trading has been the best one. And the only thing we finally have had to do was to think about that magic number factor of 2, which was indeed not the best choice at the very beginning. We could improve that strategy by going here for that multiplier of 1. I tried some others as well, but it doesn't change the overall picture that much. Everything is good for that kind of strategy. So that means even without any optimization, and we don't have to optimize all the 100 individually, we can achieve remarkable results. And since we realize that we can change the parameter and that those changes don't have that much impact on the overall equity, means that strategy is extremely robust. And from my experience, I can say that kind of simplicity and that we can change the parameters on those large scales means we can expect that it will work for the future as well. But I have to make a comment. That's no mathematical proof. I cannot not even prove it. If so, it would be very good, but I don't see a chance for that. And of course, it's no guarantee. That means it worked well for the last 18 years, has been extremely robust for the last 18 years. But of course, as always for trading, it's no guarantee that it worked for the future as well. But it looks quite well, and it's my favorite one now. Okay, that's for stock trading. So you see, simple strategy. It's really nice to see that. Next month, we switch back to Forex, and you will see we do some crazy stuff then again with remarkable results once again. You will see. Hopefully you enjoyed. If you have interest in the Excel sheets, just send me a message to that mentioned email address here. I make sure that you get everything. And if you have any other question, you just send me an email as well, maybe related to JFD Invest, or you can contact support of JFD, no problem, but you can contact me personally if you like. So enjoy your time, enjoy the evening. See you again, hopefully, for the next webinars. Bye-bye.